Hello, my name is Faith, and today we're going to be talking about pensions and inheritance tax. Recently, it was announced that the rules about what happens to any pension money left when you die are due to change from April 2027. In this video, we'll explain what inheritance tax is, how it works, and what it means for the money in your pension. When you die, your beneficiaries may be charged inheritance tax on your estate, which includes any property, money, and belongings. The amount of inheritance tax they might have to pay to the government varies, depending on the total value of your estate and who it's being left to. The standard threshold for inheritance tax is currently £325,000. So if your assets are worth less than this, inheritance tax won't be charged. If you give away your home to your children or grandchildren, your threshold can increase to £500,000. And even if your estate is worth more, if you leave everything above the threshold to your spouse, civil partner, a charity or a community amateur sports club, then inheritance tax won't apply. Additionally, if you're married or in a civil partnership, any unused threshold when the first person dies can be added to the other person's threshold when they die. This means that married couples and civil partners can potentially leave up to £1 million free from inheritance tax. But if you aren't married or in a civil partnership and don't have children, inheritance tax at 40% could be charged on everything over £325,000. Note that if you have a large estate worth more than £2 million, the extra £125,000 threshold when leaving your home to your children or grandchildren will be reduced by £1 for every £2 the estate is worth over £2 million. Now this means that once your estate is worth £2,250,000 or more, the extra threshold will be completely eaten away down to the standard threshold of £325,000 free from inheritance tax. If your estate is worth £250,000, then no inheritance tax will be charged, as it's £75,000 below the current threshold. If your estate is worth £500,000 and you leave it to your spouse, it'll be free from inheritance tax. But if your estate is worth £500,000 and you leave it to your best friend, inheritance tax charges will apply. The estate value is £175,000 over the standard threshold, so with inheritance tax at 40%, the tax owed will be £70,000. If you leave 10% or more of your estate to charity, it means a reduced rate of 36% inheritance tax will be applied. There are some reliefs and exemptions for gifts during your lifetime, but this video focuses on pensions. For more details about gifts and inheritance tax, you can find a link in the description below. Currently, pensions sit outside your estate and usually don't count towards your inheritance tax threshold when you die. However, some conditions do apply around how old you are when you die and the type of pension you have in place, which determine whether income tax is applied. And we'll cover this later in the video. The position on pensions and inheritance tax is set to change in April 2027, so that inheritance tax will apply to pensions and death benefits. It's worth double checking details on gov.uk. We've left some relevant links in the description box below. Currently, if you have a defined contribution pension, like those offered by PensionBee, it's pretty straightforward to pass your savings to your beneficiaries. If you die before 75, your beneficiaries have 2 years to claim your entire pension pot, either as a tax-free lump sum or tax-free drawdown payments, without incurring an income tax charge. They may also be able to use the money to buy an annuity and won't have to pay tax on any of the payments they receive. How your beneficiaries can access your pot depends on the provider's payment options. If you're 75 or older when you die, your pension won't be subject to inheritance tax, but your beneficiaries will have to pay income tax at their usual rate. But from April 2027, any money left in your defined contribution pension when you die is due to be counted for the purposes of inheritance tax, as would any income payments to your beneficiaries via drawdown or an annuity. If you have a defined benefit pension, which is also known as a final salary pension, or you have an annuity, you may find it more difficult to pass it on to your beneficiaries. This is because your scheme may now have a narrower definition of who can be classed as a beneficiary, for example, a dependent or a spouse. Whereas with defined contribution pensions, you can usually nominate anyone you wish as a beneficiary, for example, a partner, child, other family member, friend, or charity. But currently, if you haven't retired and die before you reach 75, your beneficiary will usually receive a tax-free lump sum. If you started to draw a pension or you're older than 75 when you die, your beneficiary will usually receive a portion of your pension, but this may be subject to tax charges. Now, from April 2027, the death benefits from a defined benefit pension, such as a lump sum death benefit, will be counted for the purposes of inheritance tax. The exceptions are where funds can only be used to provide a defined benefit dependent scheme pension and where the lump sum death benefit is paid to a charity. These won't be included when calculating inheritance tax, although the pension recipient will still have to pay income tax. To make sure your pension goes to your loved ones hassle-free when you die, here's a few things to think about. Make sure your pension provider knows who your nominated beneficiaries are and keep this up to date. With PensionBee, you can easily add beneficiaries by heading to the Account section in your Beehive. Simply fill in some details about the person, people or charities who you want to receive a portion of your pension when you die. Track down your old workplace pensions and think about transferring them into one place. It can make things a lot easier for beneficiaries to manage and means they have access to all of your pension savings in one place. Think about writing a will. It's not essential to pass on your pension, but it does make things much easier and can ensure your wishes are respected. A will can remove any doubt about who you wish to administer your estate and how it's divided. It also means your loved ones can obtain probate rather than having to go down a sometimes lengthy legal process of obtaining a court order to be able to manage your estate. Finally, the new rules around inheritance tax from 2027 aren't yet confirmed. The government is still figuring out how these changes will be implemented, so it's worth keeping an eye on any announcements. Remember, pensions are an investment, and like all investments, the value of your pot can go down as well as up over time. Your capital is at risk. This information should not be regarded as financial or legal advice. For more information, check out our Pensions 101 playlist. Thanks for watching.